Hi, everybody. Welcome to our next webinar. We already had like tons of webinars for the past couple of months, and we have another great speaker who agreed to speak to our global audience, James Sowers. He is top 50 angel investors by Forbes, according to like 2017 Forbes, I think, right, or something like that. I don't recall exactly, but this is a great opportunity for us to have James talking about fundraising strategy. You know, strategy is an important, and all founders work on strategy, but did you ever try to hear this kind of strategy from an investor perspective? And if you're talking about fundraising strategy, you need to know what investors are thinking and what's their insights. And James is happy to share it with you guys today. Quick information about our community. We are a free community for entrepreneurs created by entrepreneurs. Basically, it's English-speaking community where global entrepreneurs meet each other and help each other to go global. Free doesn't mean that everything's going to be sold for you. You are here to build your network, to help each other, and build your global reputation. And then all our opportunities, all global opportunities will be in your hands. Basically, we already have a team of about 37 people spread across the world with a mission to help you. So we are presented in like 30, already over 30 countries, and all those countries can be your market. And we are happy to help you with entering those markets at no cost. We are a non-profit community. But what we expect from you is you being active on our community. You invite your network, other entrepreneurs, so they can benefit out of this content and these opportunities. And you're also open to help other entrepreneurs. For example, you are living in Singapore and you would like to enter Mexican market. How would you do that if you don't have any network? So you can contact either our leaders of those markets or founders in those markets, and they can help you there. But they also want to enter your market, and they can contact you and ask some questions and probably some recommendations or connections, and you also can help. And this is how it works, and this is why it's free. And the more people we bring to our community helping each other like that, the stronger our network is. I believe that in the near future, we can really enter any market with, at a very fast pace and at a very low cost, probably even at no cost at all. So about past events, we are a global community recognized by large organizations, but also global known speakers like Bob Dorff, like Elias Tribulaev, like Bill Reichert, like Steve Hoffman, like James Sowers, and many other great people. Those people are usually never participate at every event. Their time is very limited. It's very hard to get them, and usually you participate at paid events to get their attention. But at our community, it's all free, and they come to help you, not for PR purposes, but to really help you to achieve some results, and they do it for free. They prepare some topic, and then they spend time, a little bit of time with you to answer your questions so you can network with them. We also have a live pitch to global investors for those startups who want to enter global markets and raise global capital from global investors, mostly US investors. And this type of global pitch we will be doing frequently, and we will have some more announcements. About our next events, we will have a great speaker that will talk in Russian for Russian-speaking audience. That's usually an exception. We are absolutely English-speaking community, just to be clear. But this one is important for Russian-speaking audience, is how to actually start company from Russia and enter Western markets. And because Roman has a lot of connections in Russia and his audience wants to hear him in Russian, we'll try to do it in Russian, but next webinars with him will be in English. Don't worry about that. Another great event is coming in 2 weeks about e-residency of Estonia. Guys, it's United States is a great market, and we'll keep giving you all possible support and recommendations and connections how to enter it, but it's not limited with the rest of the world, right? And many nice locations have opportunities for startups. And for example, Estonia, e-residency of Estonia, so you can open yourself a market in of entire Europe through Estonia. How would you do that? Is this webinar about this kind of opportunities. Estonia is a great actually market, and they have lots of tax breaks and startup and nice startup ecosystem in there. I encourage you to learn about that. I mean, we are a global community with lots of connections, so we give you opportunity to build your own international network. So you would need to come to our monthly founders meetup in the Go Global World, right? And you meet founders from different countries. And the next one will be in October 2020. It's every first Friday of the month. Similar one we have in Russian for Russian speaking audience. It's the last Friday of the month. And it's amazing what's happening in there. Like people from different parts of the world never met each other. In 5 minutes, start helping each other, exchanging connections, and hopefully bring each other's business to different markets. This is the purpose of this community, and this is what we do. If you like our webinars, would like to participate, learn from these amazing speakers we bring, and I personally interview every single speaker like at least once or maybe sometimes twice, and we always prepare for every meeting. So this is the QR code link for our Eventbrite page. Just follow that page and you'll be notified of every new event we post. About our partners, we partner with GSD Venture Studios, Skolkovo Technopark, Skolkovo School of Management, Access Innovations in Israel, Mindhive in Australia, IBConsulter in the United States, RUSBASE, Adventureland, High School of Economics in Moscow, IT Park in Uzbekistan, Embry-Riddle Aeronautical University in Florida, United States, Colaborativo in Mexico, StartupNews in India, Visionaries Russia, Yosh Entrepreneurship Support in Uzbekistan, Expert Dojo in Los Angeles, United States. And it's not limited with that. We'll have more partners. Those organizations are there to strengthen our network and our ecosystem, so you can use those their resources, their network, to enter different markets and get more expertise. How to join our community if you're not there? It's very simple. Find us on Facebook, Go Global World, or scan this QR code. This Facebook page is connected to 90 groups of different startup ecosystems of different countries where we have leaders as well. And those local communities might be your country where you live in, so you can also join it. And we also have a group connected that is called Go Global World Chat, where global founders can ask questions each other and help each other. So this is another opportunity for you to build your global network. And similar chats we have on Telegram and on LinkedIn. It's also both called like Go Global World page and Go Global World chat. This video will be posted on our YouTube page. And as I already mentioned, we are a non-profit community, so make sure to like it, subscribe it, leave your comments, maintain discussion about the topic in the comments. Maybe ask James in the comments in future when you will be watching it on YouTube. And of course, share it in your network, because we don't have any marketing, we don't have any budget for it. And the more entrepreneurs would see this content, the more results we achieve as a community, because we want to help entrepreneurs to enter different markets. And this free content is created, as I said, not for marketing purposes, but with a purpose to help. If you like what we do, or you would like to participate in some other activities, so you would like to become a leader of the community, or you have some questions to us and you need some more information, those are my contacts. Just reach us out. We are happy to help, happy to chat with you, and as well as our global team. On this note, I stop my presentation, and I let James to introduce himself. And James, let me know when you want me to open your presentation, so we can start your slides.
Okay, great. Thank you. Thanks for having me here, and thanks to the organization. And hello, everyone. Thanks for taking the time to listen to the presentation today. Everything that I'm going to present is meant to be a guide. Nothing's written in stone. It's just basically a collection of experiences and observations I've had over the last 4 years. So yeah, go ahead and open up the presentation.
All right, I'm starting the presentation. Nice slides, by the way. I like the style.
Thank you.
This is James, by the way. Tell us about this picture. How did you get this picture, by the way?
Yeah, so the picture, if I put the topic fundraising, do you have a strategy? It's kind of like a cowboy hat. Number 23 is Michael Jordan, one of my heroes. You know, he always says, you know, impossible is often only an illusion. And a lot of things when people do startups kind of seem impossible because you're envisioning a future that doesn't exist yet. So for people who know that, you know, limits are often only an illusion, they move forward towards their mission. They keep on striving. They get knocked down. They get back up, but they keep on going because they know that they're creating something special that's going to change the world if they succeed. And sometimes, you know, it's just too early because of the timing, because every good idea eventually ends up being right. But, you know, you're kind of like the explorer. So, you know, Michael Jordan, he kind of made the NBA what it was when it was having hard times. So he's one of my heroes. And the cowboy hat is because one of my names on social media is Asian Cowboy. And I actually made this picture on Snapchat where they have the thing that you notice I got the spectacles and they had those new avatar type things. So I was like, yeah, well, I'll just do that.
That's pretty cool, man. That's a nice story. Thank you.
Sure. So basically, Mike Tyson once said, you know, everyone has a plan until they are punched in the face. And a lot of people ask me, other investors, and I've seen different presentations and places I've been, you know, what are VCs looking for? But I think they're really asking the wrong question. So that takes us to the next slide. Know your audience. Are you building a venture scale business? Because, you know, not everybody is building a venture scale business. So depending on your stage and sector, the answers will vary. Who your target investor should really be. And I would say, you know, the general rule of thumb is if you're a technology startup, a venture scale business is a rocket ship, a company that can scale relatively fast and reach escape velocity. Or maybe it'll crash and burn, but that's okay. That's how rocket ships are built. You know, venture capital firms and many professional angel investors are focused on companies with a potential for 100 million plus in revenue in 5 to 7 years. And a startup needs to exit 3 to 5 times the amount of money they've raised. Because there's a lot of dilution, you know, as you continue to raise money. So sometimes $1 billion company exits, but the investors actually didn't make that great a return if they raised $1 billion. A lot of people don't really realize that. And, you know, things like deep tech, literally space rocket ships, electric vehicles, climate change, green energy stuff, and biotechs, they may be pre-revenue and even have an IPO at that stage. So it really depends on what type of company you're building. So the next slide, the types of fundraising. Because there are many different types of fundraising, especially in the United States, that people don't often consider. There's product crowdfunding, like Indiegogo, Kickstarter. You kind of like proving out your product, you put it out there, and then people will basically pre-buy it, and they may get additional perks for doing that. But you're not actually giving up any equity in the company. So I look at it kind of like a pre-selling your product. And then there's a thing called equity crowdfunding. There's a couple of different types. There's Regulation CF, which is easier to do, but there's a smaller limit on what you can raise. As of today, it's $1,070,000. They're supposed to actually change that to 5 million, which I think will be great. And then there's Regulation A+, which is a lot harder, where the cap, I believe, is currently 50 million, but they're supposed to raise that also to 75 million. And that's a pretty interesting way to go. originally VCs and professional investors were kind of skeptical, but now that's kind of being mixed in where companies are doing some Reg A crowdfunding too, because now your customers can buy your product and become an investor, so they have an upside in the company, so they feel like they're part of the company. So that's a pretty interesting thing. And then there's the friends and family round where you just start out with your idea, and maybe your uncle believes in you, your mom or dad, or your best friend, and they may put in a small amount of money to help you get started. And then you have various types of angel groups. Some of them are really organized. Some of them are just kind of go with the flow type thing that people raise money from. And then a lot of people don't even consider this, but there's also loans. There's things like ClearBank now where startups can get loans if they have revenue. And there's things like factoring and just other types of small business loans out there, especially in the United States, to help people get started. So that's all kind of interesting things that people should consider. I always believe people should look at the whole scope and then use critical thinking and say, hey, what's right for me? Because not every path is right for everybody. And sometimes it's a combination of things that get you to the next level. And in the next slide, I talk to think about the tools of fundraising. You have pitch decks, which everybody always talks about, but then there's data rooms also. And I always like to mention too, everyone thinks of pitch decks like the investor deck, but there's really two types of pitch decks. There's one for investors and one for the customer. Because when you're trying to acquire a customer, you may have language that's basically specific to that domain, and the investor may not understand what that is or really be thinking about that. So basically you have to know your audience, who you're speaking to with the pitch decks. And I always like to say investor pitch decks should really be relatively short, 10 to 15 pages, because the real goal of the pitch deck is to get the meeting. It's not to really just get the investment right there and then, but to get the meeting with the investor and get the process started. And then you can always have a longer pitch deck that can be 20, 30 pages with appendix and things like that. So when you do your presentation, you'll have that. But the original pitch deck should be relatively short, because keep in mind, a lot of VC firms and professional angel investors literally get hundreds of decks. So it's kind of hard to go through 30 pages. And then there's the thing called the data room. And the data room, which I have about on the next slide, I have a couple of things about the pitch deck we can take a look at and discuss. But the data room basically has more information. So once you get the meeting with the investor, you might say, hey, would you like the next step to see my data room? So the next slide, your pitch deck. What should be covered? So in your pitch deck, I mentioned, 10, 12, 15 pages, you should be the following. So these are the things I found should be in the pitch deck. Your vision, the problem you're solving, your unique or 10x solution. Because a lot of people nowadays are doing the same thing, but why are you 10 times better? Why are you solving a problem? Why are you a painkiller? Why are people going to use you instead of the existing or the status quo? And another thing that's really important is why you, why this, and why now? So why are you doing this? Are you compelled because you have a passion for it? Is it something you experienced in your life as a problem? And then why is this going to be game changing? And why is your team the right one to do it? And then, of course, why now? Because the timing is the number one reason companies succeed or fail. And then the current and future TAM. Like a lot of people say, I'm going with a big market, and they ask for the TAM. But I think what investors are really thinking is the future TAM. Because what's a big company today or a big market can be disrupted and be a small market tomorrow. I mean, just look in the public markets, how 20 years ago or 30 years ago, certain companies like IBM were the leaders, and then it changed to Microsoft and to Amazon and now Apple. I mean, it changes, every couple of decades. And then competition. And the funny thing about the competition is some people say, I don't have any competition. But there's always someone who's tried this in the past and possibly failed, and there's always fragmented competition you might not know of. But it might even be if you're creating a market, like the status quo is your competition. And then in your deck, you should have something about your product and your go-to-market strategy and how you plan to make money in the future, your business model, your traction, and then a slide about the team. And there is some debate on whether or not the team slide should be first, second, last, in the middle. So it kind of depends. I always kind of say that's up for debate, but obviously if you had previous startups and your team has had great exits or created great things, then the team slide should be closer to the beginning. But if not, it should be closer to the end. And then any financials, if you have anyone. And sometimes in the financials, you're just saying, your ask, basically you're raising this on convertible note, how much you're raising and things like that. So early stage decks, I always say and kind of pro formas are kind of more BS projections. but they show the quality of the entrepreneur's thinking, because obviously nobody knows the future. And as you build and you measure and you learn, things will change. I think that was from the book. I read that somewhere, the Lean Startup by Eric Ries, which is a great book that I recommend startups should read. And another great book too is 0 to 1 by Peter Thiel. So deepening a little bit more into the deck, I always say, the company purpose. Define your company in a single declarative sentence. Because, some people go on this big, long paragraph, this big, long description, but if you can't really describe it in one sentence that I would say like kind of barbelled like your grandmother or a 7-year-old could understand, it's too confusing. So it's good to get the company purpose down to one single sentence. And then your problem, describe the pain point of your customer. How is this addressed today, and why the current offerings are totally inaccurate? So basically why you're better and 10 times better. Your solution. How is it unique? How big can this really get? And then the why now. Is this a technology inflection or an adoption inflection? I come to find there's either a technology inflection, maybe the technology is cheap enough now that you can do this, or an adoption inflection, like for instance, now that we're in COVID times, maybe it's the adoption where people are more open to work at home things, video conferencing, mental health things. And then on the market size, how can this be really, really big? How big is this market in the future? Because, angels that have made a lot of investments in VCs, they need a really big exit in order to make up for all the companies they invested in that weren't big exits or even went to zero. Because, 70, 80, maybe 90% of companies may go to zero, and a lot of exits aren't great exits. Sometimes things are just sold for the tech, or just got your money back, or you get shares in another company and you're still waiting for an exit. So that kind of varies. So you need the really big outliers to make it all worth it. And then the competition. Who are your direct and indirect competitors? How are you specifically different? And then the product. Describe a little bit about your product and your business model. How do you actually think about making money? And then, of course, the team, the founders, the management, the advisors. And then your financial metrics. And you can add growth and charts and things like that. And then your data room. So in your data room, that's something a lot of people don't really talk about a lot. But your data room, when you're early, you may not have a lot of stuff. It kind of depends, but you should at least have, stuff like your docs, your term sheet, your convertible note, your safe, your early cap table. And it's very important to have this. You'd be surprised. A lot of startups don't actually have this stuff organized. And that kind of shows, if you're prepared and you have this, it puts you like a leg above the rest at seed stage. I mean, obviously in a price round or Series A, if you don't have this, the VCs are expecting you to have it. It'll be frowned upon. But if you actually have this at just the very beginning stage, it shows, wow, this person's prepared. They thought this out. And if you have any financials, income statements, balance sheets, anything like that, that's great to have. Anything about the team, the advisors and the board members in your data room. And a lot of people leave this out about the IP and tech. They don't realize, if you have any patents or provisionals filed, that's great. But there should at least be, tech agreements that shows, hey, the people who work here, the IP is actually assigned to the company and they don't own it, because that can become a very big problem in the future if that's not the case. And of course, your incorporation docs, Delaware C Corp in the United States, and in some cases LLCs, but in the United States, it's a lot better to be a C corporation if you're trying to get, venture investment. And if you have any LOIs, contracts, anything like that. And then, your product roadmap, your marketing plan can be in there, your marketing channels, your CAC to LTV, any cohort analysis, potential unit economics, and your customer pipeline, anything else that you feel relevant in your deck. And if you are in diligence with any investors, anything that they've added or you've added because of them is usually helpful too. So in the next slide, we get into, getting investors is a process. A lot of people don't realize that. It's a process. So I think I just passed the data room. I didn't say next slide, but getting investors in process is the next slide. And depending on the size of your round, be prepared to take a lot of meetings. That's what a lot of people don't realize. You have to make a plan. I mean, this could take 100, 250 meetings. I mean, the minimum 50 meetings, because you got to remember too, every investor you meet may not be right for you. You might say, hey, this guy's not a fit for me. So it's better to have more meetings so you can pick and choose. So I always say when you make your game plan, you have to sit down and think, kind of like in the military. There was a guy who was a captain or a sergeant or whatever told me, they always analyze the terrain And I was like, okay, that's interesting. So how do I analyze the terrain in every aspect of life? So, in startups, you have to say for customers or investors, who's my target? So you analyze, who's my target? So you say, great. You make a list of maybe 200 or 300 targets. You do a little research and you say, okay, this one's not at my stage. This one is. And it's also important. So who is the partner that I contact? Because some partners might be specific to your sector. But it's a very bad idea just to go basically emailing every partner at the firm, because that shows, hey, this person is kind of just, sending it out to everybody, hoping somebody responds. And so that goes into the plan. I found out who I want to reach. Now, how do I plan to reach them? Now, the best way, obviously, is warm introductions. Because, just spamming everybody on LinkedIn or email or buying some database list and then asking for intros to people you don't know, is that the wrong way? Especially if they don't know you. Just imagine if you get an email, say from somebody, hey, I don't know you, but introduce me to so-and-so or one of your customers or something like that. You're going to be like, wait a minute, I don't know this person. This is kind of strange. So the right way really to get investors is warm outreach. And I found one of the secrets is if you get to know other founders and ask for intros to people in their network, and even better, if someone has invested in a founder, if you build a relationship with the founder and then say, hey, can you introduce me to this investor you have? But before you just go asking for stuff, it's always good maybe to reach out to the founder and say, hey, I'm so-and-so, I'm doing this startup. Is there any way I see you do this? Is there any way I can help you? And I'd be interested in learning from your experience, something like that. If you have the time, thank you very much. And then, once you build kind of a relationship, then you can say, hey, I saw so-and-so invest in your company. Do you feel comfortable in making an introduction? Or if they say, well, they're really looking for this, that, and other, and say, well, what would make you feel comfortable? So it kind of gives you, a roadmap, a gateway. Now, if you do some cold outreach, because people do that, and sometimes you have to do that, I would say a big, big mistake people make is they'll send this long email or this long message on LinkedIn or something, talking about their whole life, about their company and all this and that. But the best way is to simply explain who you are, what your company does, going back to the simple explanation, and maybe a paragraph or two at most. And then maybe you get a response and maybe you don't. If you don't, maybe you follow up one time again. But just keep in mind, a lot of the investors that are somewhat known in the VC firms literally can get hundreds or thousands of these. So the best way is to make it short and concise. Like I always say, when I get like a short message or a short email, I'll read the headline and then maybe I'll just delete it. But if I don't delete it, then it moves me to the next stage and I'll look to see how long it is. And if it's short enough, I might read the first paragraph and it's kind of like people start at 100 and they're disqualifying themselves. So I may read, hundreds of these things, but not read the whole thing. And then another thing too is you got to at least do a Google search on your investors. There's so much ways to get research now. I mean, you can Google search them and find out, what they've talked about maybe in podcasts or interviews, or if anybody's just saying this about them, good or bad. And then another great thing is if you can talk to any founders they invested in where the company failed and see, how they reacted and just get a perspective on that. I mean, there's always two sides to every story. So a company fails. Sometimes somebody could have acted a certain way and the founder said, hey, I'm not happy with that person, but you don't really know the whole story. But then there's other cases where the founder said, yeah, it was no problem. And they said, just take a little break or let me help you get a job and I'll invest in the next one. So it always kind of depends on the story. And if the founder says, something that's favorable, you still have to kind of verify that with another source. But if it's unfavorable, then you need to verify that too. And even if you're talking to the investor, just bring it up. Say, hey, I talked to these 3 founders. 2 of them said this. One of the companies failed. They said you were great. But in conflict, another company said they failed and they weren't really happy with how you acted. Why was that? What was the difference in situations? And then you can learn their way of thinking. Because one of the things investors like to do is learn your way of thinking. And then you can know if you're a fit for each other. So I think that's a really great thing. And then in positioning yourself for success, practice and record yourself. Some people say stand during your presentations. I don't know if that's necessarily true for Zoom pitches. I think that's kind of controversial and everyone's still learning. But I definitely believe in practicing. Record yourself in the pitch because you might see yourself pitching and be like, wow, like I have a tendency to talk too fast. But people might say, well, I didn't know I sounded like that. Or I didn't know I didn't appear as confident as I thought I was. And you can just learn by seeing your pitch and make improvements yourself. And then, of course, practicing getting others' opinions is great. But sometimes the best critic is just watching yourself, recording yourself. So I think that's a really great thing. And one big thing about the pitch is architecting your story, explaining what you are building. that anyone from a 7-year-old, as I mentioned before, to a 77-year-old grandma understands in one sentence. And that's the great thing about the pitch too, because you can look at yourself and say, hey, I feel enthusiastic, but it's not coming across in that video. If I didn't know myself, I wouldn't know that I'm, the messiah of this, that I'm really in love with what I'm doing, that I'm not showing you emotion, I'm not getting it across. And then I would say, once you do that, then you go out into the wild, for lack of a better term. I mean, kind of on my Zoom background, I put the bisons out in the wild kind of for this presentation. And you have to start with a plan. So maybe you start with a 4-week plan and you build momentum. So just for example, you might start out with friends and family. You give the pitch for practice and you just happen to say, hey, would this be something you'd be interested in investing a little bit of money in? And if they say yes, I would close that right away, because now you're building momentum. I think a lot of people at a very early stage will say, hey, I want to raise, $500K, $1 million, or whatever it is. They get friends and family to say, oh yeah, I'll do it. And then when it comes time to collect the money, it's either not there or they're not really building momentum. And I think it also shows credibility to an investor who said, hey, yes, I went to friends and family and, I closed 50K. And then I think subconsciously you feel more confident. So then you start going to angels and maybe some angel groups. You start pitching them and applying. They're like, hey, this person seems confident. Their story seems big, that you get to pitch to them. And then you can close them. And you're like, wow, I'm really building momentum. I've closed friends and family. I've closed some angels. Then you move on to the next step, maybe depending on your stage, you're closing micro VCs. You get to close there. Now you've built, 3 steps of momentum. And then when you go for larger checks, some of the VCs that might write a $500,000 check, $1 million check, you're full of confidence. You can show, hey, I closed this person, this person, this person, this angel group, this micro VC. And you're like, wow, this person gets stuff done. Because remember, in the beginning, we're trying to figure out, can this person execute? And, if there's not a lot of revenue or a lot of customers, you're saying, hey, how's this person really executing? But if they showed they've been able to fundraise, they had a plan, they closed people on stages, they're like, wow, this person's a step above the rest. And one thing, nowadays, anybody can start a startup. It's so easy with technology that the competition has gotten so hard that the ability to execute and fundraise to put gasoline on the fire for growth is really important. So the ability to fundraise has become more important than ever, unfortunately. And then your fundraising KPIs. A lot of people say, this is my KPIs in my business. This is my OKRs, the different names they like to use for them, acronyms. Obviously, you need to have a fundraising KPIs for your plan. You don't necessarily need to share them with a lot of people, but just with yourself. So you can review them, daily, weekly, monthly, throughout your 4-week plan and say, hey, am I hitting my KPIs? What have I learned? Do I need to adjust? And I would say, commit to try to take 4 meetings a day for 60 days. I mean, this sounds like a lot, but with Zoom, if you can't do it with Zoom, it's easier than ever. Because back before the pandemic, there were founders that were making plans, going to San Francisco, New York, different places, and meeting whoever they thought would be interested in their company, getting referrals from people, talking to people, who should I be pitching when I go to New York, setting up these meetings and staying there for a month, 2 months, and meeting 60 investors, 100 investors. So I always say with Zoom now, it's actually made it much, much easier to do this. So I know it sounds like a lot, but let's just say 4 meetings a day for 60 days, that's basically 240 initial meetings. And some percentage will be a pass, some will require a follow-up. And then by the 3rd meeting, I would say ask for some type of decision. Now, depending on the check size, you might not say, if it's a firm that writes $1 million check, hey, give me a decision now, we've talked 3 times. But, you might ask, hey, what do I do to go forward? Can we go into diligence? Let me send you my data room. What are the next steps worth taking? And then the next slide on investor meetings, I just kind of reiterate about telling the big story. Because remember, long odds, an extraordinary outcome. Because believe it or not, venture investors and professional angels are generally looking for very long odds that have an extraordinary outcome. The next Facebook, the next Uber, the next Amazon. And remember, when you tell the story, with their help, they're the hero. If they help you, they become the hero of the story. Just like when you're talking to a customer about your product, you want to make them the hero. Because I've noticed about Facebook and Instagram, the real hero, they make you feel like you're the hero. Everybody likes to post about their life, show their children. They're like, wow, I'm a hero. I have a voice. So making person a hero. Just like even something like Uber, the driver is the hero. They're transporting people from place to place. The host in Airbnb is the hero. They're providing a service for people to stay that's cheaper than hotels or a nicer experience. And I always say, be prepared when you present with or without slides. Different investors like to do it different or have different processes. And they may change from time to time. And even with Zoom, people might have really changed their way. So even if you ask someone who they invested in, how should I present to them? It may actually be different now. I mean, we don't know. They may be adjusting too. And I would always say, be prepared for interruptions, because nowadays at work and home, people have kids, they have pets, and you might have those too. Or, there could just be some kind of technological glitch. So be prepared for interruptions. But no matter what happens, remain poised. You're in control. You're taking control of the situation. You're ready to roll with the flow. And that shows people too that you can adapt and adjust. Because one thing I've learned is the successful founders adapt and adjust. So everybody gets knocked down, no matter who you are, even the biggest people in the world, the Warren Buffetts, the Jeff Bezos, Bill Gates, they get knocked down, but they get back up and they just keep on fighting. And also ask VCs and, angels, and even friends and family, explain their timeline on making a decision. Because the worst thing is somebody just keeps saying, oh yeah, I'm thinking about it. If they just keep thinking about it, that's more than likely a no. I mean, there are some exceptions, like if somebody has a syndicate and they don't have, permanent capital, and they have to go out to their syndicate, they have to get a response, and they have to list the syndicate if they get enough response, and they may have to convince the syndicate, even have a webinar with you pitching to the syndicate. That can take a little bit longer, and that's fine. But if it's somebody that just says, hey, I'm a friend and family member, or someone that makes a decision usually and just invest directly most of the time, they can give you an answer. Hey, this is something I would want to do directly, but no, I'm not interested in doing this directly, but I am working with some syndicates. Let me talk to them about it. But you can get some kind of answer so you know. And I would say always follow up on the material asked for. You'd be surprised. You talk to someone and say, yeah, go ahead and send me the data room, and I'll take a look at it. And then within 72 hours, I can let you know, hey, I'm interested in possibly moving forward, doing further diligence, or it's an absolute pass. And when someone says this, always take the chance to say, hey, I understand, no problem. Is it okay if I add you to my updates list for investor updates? Because sometimes you'll pass on a company and then you get the updates, you see this growth chart going straight up. You're like, man, what's going on here? And then you may recontact them again and be like, hey, I see you have a lot of growth going. Let's talk again. You might be like, great, I appreciate it. I'm not raising money right now, but I'll keep you in mind for the next round. Or if you're still raising money, then you can have the conversation, because you just never know. So keep the relationship good. And then another great thing is the Zoom pitch meetings I'm going to talk about, adapting to the new normal, which is the next slide. So video and audio quality are investing in tools to make sure it's high quality can make a big difference these days. I hear Zoom is actually going to come out with some type of hardware that's going to make everything easier. So that'll be great. If it's a package and it's like $500 or whatever, and you get certain kind of headphones or whatever. I'm interested in seeing how that is, because I know everyone has different computers, different internet settings. I have heard that some accelerators now, when they invest in the companies and when they're having meetings with them all, they actually ship them a kit. And the best way is to take an Ethernet cable and put it into a high resolution computer right into the plug-in for your internet. So that's kind of an interesting thought. So I know that when you're on Zoom, running through the deck is not as easy on video. So some smart founders, I heard, are sending a deck ahead of time, that 10 to 12, 15 pages, and asking investors what would they like to discuss on the call. I think that's very helpful, because a lot of Zoom calls, could be 15 to 30 minutes, maybe an hour at the most. But I think it's very helpful and shows respect for everyone's time, including your own, because it helps you get more prepared, asking them what they would like to discuss. And I've also noticed too that on a lot of these Zoom calls, it's a lot easier to get all the founders on the call. And then when you do that, you should practice and coordinate who's presenting what before the call, because when it's executed well, it's a great improvement to a solo meeting. Now, I have heard recently in the Valley, some of the companies that invest really large checks are actually, after a 2 or 3 step process on Zoom, actually meeting the founders and taking a socially distanced walk. So some people are actually doing that, because I think what's happened is a lot of these funds have raised so much money, they obviously have to deploy it so they can get the fees from their LPs, and they were investing in companies they already had a relationship initially, or people they knew, or companies they've already invested in, but they're starting to run out of that. So now they actually do have to invest in companies that they don't have a relationship with, that they got through a warm introduction or somehow took an interest in. So they're actually meeting them in a socially distanced way, which is kind of an interesting concept. And I would say how well you're prepared for a video meeting in these days kind of gives a signal at the quality of the preparation that a founder is doing. And it's good, I think, to have backup slides and things like that. So the next slide is about answering questions from investors. So one thing I always say is, don't hide relevant information from investors. I mean, I know everyone wants to present themselves in the best light, and obviously you're telling a big story of a future that may not even exist yet, and that's great. That's what people like to hear, but don't hide relevant information. I mean, if you founded a company 3 months ago and one of the founders quit, but you kind of messed up and there wasn't vesting in the equity, and this person owns 10, 15, 20% of the company, they're already gone, don't hide that, because that's going to be found in diligence anyway. Or if worse, if it's not, and then someone invested, that could actually be considered securities fraud in the United States. So don't hide relevant information. And I would say answer questions with short, concise answers. I've noticed, especially in pitch competitions, someone will ask a question, a judge or maybe the moderator, and the person will just go on this long tangent and sometimes never even answer the question. But I always find it adds credibility when people answer the question basically, short and concise as possible. And it's okay too, especially in a setting like a pitch competition, saying, that's a great question. We'd love to give you a detailed answer. Let's take this offline. And here's the funny thing about that. You're actually getting a meeting by doing that. And I would say, you start with 100, like I kind of mentioned before, and lose credibility from there. I know a lot of accelerators in their applications are actually looking for stuff to disqualify people each round until they get to the actual meeting. And just like I kind of mentioned before, it's really important. Build relationships for future raises. And when you're on an event like this and you reach out to somebody, it's always good to say, hey, I heard you on this event. This is why I'm reaching out. Because you get hundreds and hundreds of messages from people you don't know randomly. And if you don't know where it came from, a lot of times you'll either ignore it or you might not, give them the answer they want. And then just like I mentioned before, remember, even if they pass, don't take it personal. They're not passing on you as a person. They're passing on this investment right now. You don't necessarily know the reason. It might be that they may think there could be a better technology or a better team suited to do this in the future. And a lot of VC firms don't like to invest in the same type of thing. Now, sometimes that can get hard because someone could do something and pivot, so you are competing later. And there's different points of views on this because some accelerators will invest in competitors, but just not in the same class. Or some of them maybe not in the same year, but in a class in the following year because they have 2, 3, 4 cohorts a year. So there's kind of a lot of different thoughts on this. And there's so many pivots these days that competitors may actually end up acquiring each other and being friends. So it may actually help. So it's kind of conflicting views on that. But always remember, even if they pass, just add them to your investor updates list to let you, and just be friendly with them. Because you never know later on down the line, the person that you were dealing with, that you thought, hey, this person passed on me, they're their associate, they didn't take it to the partners, they might be a partner at Sequoia in 3 years. And you might be pitching them for your Series B or something. So always remember that. So on the next slide, I kind of talk a little bit about successful startups, the 3 T's. The right time, which we kind of mentioned before, the right team, and the right technology. So the right time is obviously very important because even like the great Reid Hoffman tried to do, I think it was called SocialNet, a social network, but he was too early and it failed. And the guy, Mark Pincus, did some kind of social network too that had failed. They were just too early. And then there were people who came out like ClassPass, Friendster, which a lot of people never even heard of, even though Friendster actually made it to be a public company. I don't even think they exist anymore. And then there was MySpace that most people heard of. And then Facebook came and, was the big winner. So they did everything right at the right time. And of course, the right team. You have to have the right team doing the right things at the right time, executing. So the right person for the right job. And then the right technology. It has to be the right technology. And I always say too, that if you're not trying to disrupt yourself once you get to a certain size, someone else is going to disrupt you. So you always got to be thinking, how can I improve my technology? It's kind of interesting. A lot of people talk about, yeah, I built this app. And then they think, oh, I don't have to improve it. I built it. But no, they don't realize Facebook, Snapchat, Twitter are always iterating. It's like it becomes a living thing that's always changing, always becoming better. And you also have to remember, too, that I've talked about the inflection point. Is it adoption inflection point? Is it technology inflection point? What is the reason that you're going to succeed? And with execution risk, has the market risk been eliminated? A lot of times when you're really early, you don't know if you have product market fit. So the market risk hasn't really been eliminated. There's both. And I've found, successful founders and teams, they adapt and they learn. They do it fast. So one question I always like to ask founders is, how do you best learn? because everybody learns different. I think we're finding out now that with the school system, some kids are like super smart, geniuses, but the teachers treated them like they're not because they learn in a different way. And it turns out they were a genius. So, I would say, how do you best learn? And, do you know how your co-founder best learns? How your top engineer best learns? Because if you don't know that, then how are you going to communicate with them? How are you going to get the best out of them? Because your job as the CEO or leader of the team is to get the best out of everybody. And I always think, you have growth mindset versus fixed mindset. Does a person have a growth mindset, or is their mindset totally fixed? And one thing I find interesting, even personally, you can have a growth mindset in one area, but a fixed in another area. And I'm always, trying to improve myself, thinking, well, I have a growth mindset in this area, but why is my mindset fixed in this area? How do I know I'm right? And then, how do you differentiate between a permanent shift or a secular shift? So this is one thing I started thinking about, and I'm sure a lot of investors have, and founders probably should too, with COVID happening. Because you have to think, okay, what has changed? Great, this has changed. Is it a permanent change, or is it just a temporary change? And if so, how do I think about the difference? Because a lot of talks I've had with companies I've already invested in is, hey, okay, so we're making this change now. Is this permanent, or is this just temporary to get us through? And what's going to change in the future permanently? And how do we move where the puck is going? I think it was Wayne Gretzky. He said, you got to skate where the puck is going. And another thing I always think about is non-consensus. So what's your variant perception? What's non-consensus and right? What is the founder's view of the world that's different than everyone else? And why do you feel you're right? What do you know that other people don't? And then we kind of talked about this a little bit before. Investors, they need to exit at 3 to 5 times the money raised. So that's not the valuation they invested at. That's 3 to 5 times the money that you raise. So, if you raise 500 million, a good exit is probably, 1.5 billion, 2.5 billion if you raise 500 million. But if you raise 500 million and exit 700 million, that may not be such a great exit for investors. And I always like to think about too is keep cash expenses low until you have product market fit and at least 3 customers. And when I say at least 3 customers, that doesn't mean like your best friend, your mom, somebody who said, yeah, I'll just try it. Let me try it. It's not really using it. But, 3 customers that might be pilots. Now they may be unpaid, but it's people that and if someone's inside an organization championing your product. So at least, 3 different companies that are doing that are customers. And then on the next slide, before we get to questions and answers, you can reach out on LinkedIn, but if you happen to reach out on LinkedIn, just put in the message thing when you go to connect or whatever, you heard it on here, because I get so many people just trying to connect now. I don't always connect with all of them. I tried to, after one of these things, just accept everyone in case they forgot, but I found that that's just starting to work out not to be so good. A lot of people, they're just trying to sell stuff to your startups or things like that. And then you can find me on socials. Twitter is @PrimalKey. And then I abbreviated to TikTok, I think. Oh, I have to spell that out. Good. Is the Asian Cowboy, because somebody else already had Asian Cowboy. And then Instagram, I just changed it to Asian Cowboy 12 because somebody else had Asian Cowboy. So that goes back to the original picture.
So you already had 11 Asian Cowboys before you on Instagram. It's very interesting.
Well, I don't know if it was 11, but I used the number 12 because Tom Brady, the GOAT for New England, now he's at Tampa Bay, I guess, and they call it Tampa Bay. He's number 12. So, some of my heroes are from sports. I kind of alluded to them. Michael Jordan, 23. Tom Brady, 12. Wayne Gretzky, 99. Kobe Bryant, who was 8 and 24. And the interesting thing I learned about Kobe Bryant is the reason he wanted to change to 24 is because of focus, because he wanted to say, hey, there's only 24 hours in a day, and 24 reminds me to focus on working on getting my game better. Focus on the matter at hand. That's another thing I've learned too about startups or any endeavor, that where you put your main focus really, really matters a lot. Focusing on the right thing. So I know I said the right people doing the right things at the right time, but that's also focusing on doing the right things at the right time.
That's right. Yeah. A very cool presentation. Very relevant insights.
Thank you.
Love it. So we are ready to jump into Q&A part, and we already have some questions. I encourage everyone to write your questions here in Zoom in the chat, not in the chat, in the Q&A section. And if you would like to ask your question with your voice, just raise your hand. There is a special button for that. I'll let you speak. And if you are watching this webinar on live stream, just leave your questions in the comments. I'll try to catch it and also ask it. Yeah, first question is coming from Maxim. He's asking, how do you think, what is the reasonable share of a company to give to a pre-seed investor?
Okay, thanks for the question. Yeah, that's a great question because the reason that's a great question is because if you sell too much of your company early, two things happen. One, you end up basically working for feeling like psychologically that you're working for the investors. And two, when you get to later rounds, there are firms like AZ16 that will pass because a company has sold too much of their company and they feel like the founders don't have the incentive to keep going when things get hard. So I would say at pre-seed, you kind of have to go with where you're at. So if it's just friends and family, I mean, maybe 1 to 5% at a certain valuation. And then when you're going to angels or angel groups, maybe 5 to 10%, a little bit higher valuation. Hopefully you've gotten a little bit more traction. And maybe you can keep that same valuation with the micro VCs. So that's called a rolling close. And then when you get to the VCs that are going to write the 500,000 to the $1 million check, now you have to understand some VCs have a requirement that they have to own or target a certain ownership of a company. So some VCs may have a mandate, hey, we target 5 to 10% ownership in a company. So they may need to get at least 5% or they can't invest due to their LP mandates. So that's another reason in the very beginning to keep it very low, if you can, the amount of equity you sell. And then once you hit one of those VCs, okay, hey, they need to take, and then when you get further along, some of them take 20%. And I've heard now there's even some early stage funds that like to be almost the whole check, just wants to take 20, 25%. And that seems like a lot. But if you get a really good firm like Initialized Capital, it says, hey, I want to invest, and you just have an idea, but I want 25%. I mean, if you feel they're a fit for you, take it. But some random guy or family member says, oh, I want 20, 25% because it's risky. You probably don't want to take that.
Yeah, right.
Because you have the other avenues like equity crowdfunding, you have product crowdfunding. And that's why in the one slide, in the one part of the presentation, I like to make it a point. You have choices.
Yeah, I agree. Slava Gusev is asking, what are the main personal qualities of a startup leader, founder that lead a startup to success?
So the number one thing I'm finding after, of course, the timing, which you can't really control, is your focus. Focusing on the right things and the ability to pick the right team, have them focus on the right things, and inspire that team. So I always say, can this CEO, founder, inspire the people who work for him to be down for the cause? So it's hard to measure that. But one way you can measure that, when you get the data room, you can say, hey, are these people paying these people a lot of money to work here? Or are they working just for equity? Or, mostly for equity and a very small salary because, people have to eat, obviously. But in some cases, everyone's just working on stock because maybe they came from Apple or Google and they have a nice savings. They had a lot of Apple and Google stock or something like that. But that shows, hey, these people who are working there really believe in the cause. If they left Apple and are taking no salary, that's one signal, because signal is a big thing, that, hey, it signals to someone, hey, this person inspires people. They're a leader. And then another thing, too, is it kind of leads into that is, can they tell a big story? Is a big story, kind of like a Messiah evangelist type thing. Because there's a lot of controversy right now about this company in the public markets called Nikola. And who knows who's right or who's wrong or where the real truth lies. But this guy has obviously done an incredible job telling a big story. And he got GM to become an investor and a partner. And he had his investors, when the SPAC merged for the PIPE, he had like BlackRock and Value Act. I mean, this guy must tell a hell of a story because they don't really have the product yet. And he may execute. Time will tell. And I really hope he does. He might change the world. But so if you can inspire people in that way, I mean, that's incredible.
Yeah, I agree. And another question is about the tactic of negotiations with investors. Prem Gair is asking, can you please repeat what to do if investors want higher percentage of equity? And if it's not too much to ask, they ask.
Right. So I think a lot of that depends on, we talked about, the investor fit versus with you, because, investors looking for founder market fit, I kind of like to call it. And I've heard people say that, there's a founder fit the market they're pursuing. And that goes along with the why you, why this, why now. But I also like to think, from a startup standpoint, you have to say, hey, is this an investor fit for me and my team and my vision and my mission? So back to the thing about like if someone like initialized capital, a firm that can take you to the next place, needs a certain amount of equity. Of course, you can counter, but I would just be careful to pass on a deal with a really good firm that's a fit because of the percentage. But when you start to go with like friends and family and some of the early angels that aren't very well known or something like that, or certain angel groups, if it's too much, sometimes you just have to walk away. But obviously you can negotiate. And I come to find that if you're building traction and creating FOMO, it puts you in the driver's seat. So a lot of it depends on your negotiating position, but I would be very, very careful to give up too much of the company before you start hitting, at least professional angels and micro VCs. And that's another reason I like to point out, you can get loans, you can get crowdfunding, product, and equity, because now you have choices. Because I believe when you have choices, it empowers the founders where they can say, hey, if I don't get the money from this particular friend, family, or angel that I barely know, I can still build my company. I'm not dependent on them. It's just like when people go into Shark Tank and the sharks just want too much. Maybe that shark was the right fit, maybe they weren't. But some people, they say, hey, I can't do that. That's too much. Maybe that's the right decision. Maybe it wasn't. I can't answer that because I don't know their personal situation, their company situation. But everybody has to do what they feel is right for them. But I kind of think of it this way. Use critical thinking and strategically and say, hey, I only want to give up 10% of my company, but this person can take me to the next level. They can help me get the stage I need to get further investments. They want 12%. They're firm on that. Is it worth the extra 2% to do it? So, is the juice worth the squeeze?
Next question is about situations when some founders get lucky and their business model is growing well and fast, so they have enough cash to grow the company, and they might not need those investment fundings in terms of like cash. But would you would not recommend to raise a round for them, and why?
So depending on the business, if you think you can grow the business and never raise money as a founder and own all the equity yourself, then I wouldn't raise it. But if you think that raising the money with an investor that will help you grow even faster, hyper blitz scale to be the $10 billion company. Because remember, nowadays, there aren't really a lot of moats, because the moat is getting your network out there, because most markets are winner take most. So the network effect takes enormous amounts of cash. Like companies like Uber and Airbnb raise billions. So it depends on the type of business and what your goals are. So if you're happy not having a venture scale business, or maybe it comes venture scale at some point, if you think you can grow rapidly without raising the money and the investor is no added value other than the money, then I probably wouldn't take it. But if you think it's an added value from the investor and it helps you really hyper blitz scale, turns you into the winner take most company, IPOs, the next Facebook, then I would consider taking it.
Thanks. I'm meeting lots of startups as you almost, and I think every day. And the majority of them at the early stage, they have like engineering mindset, like brilliant founders with brilliant ideas, brilliant product, and but they have no expertise of raising funding. And so what would be your recommendations for people who are like obsessed with their features, with their tech, and it's their baby, and they believe that I have like this nice feature, that nice feature, and we've got like our competitors got 50 features, we've got like 150 features, because of that we are better, and they focused on that. What would you recommend them in terms of growing business and in terms of raising capital?
So I would say that, if you have a chart of users and revenue going up and to the right, investors are going to find you. But in most cases, I have found that a lot of people that are like really genius at the technical aspects, some of them do struggle to raise money. So maybe you want to bring in a co-founder or a business development person that is like, the messiah that can tell the story, attract interest, get people excited. It's probably better if it's a co-founder though, and not like, someone's just hired as a biz dev guy. But just because you founded the company, you could be a year in, you can bring another person in and make them a co-founder. There's no rule against that. But so to me, if you see in the data room and someone's the biz dev guy pitching, if it's just a hired hand, that's kind of like a red flag. But if the person's a co-founder and they're given a title like COO or Chief Strategy Officer and they're doing that, that's totally fine.
Yeah. Another question, I just and it's just coming from a Telegram chat. One of the founders who just started the company with the other founders, they got into a conflict, and the other founder wants him to give like very little equity, and those conflicts impact early stage companies like badly, like really bad. So how would you recommend to, and it's not about investments, but it's indirectly related because every investor wants to have a strong team. So what would you recommend in the beginning, in the inception of the company, for founders to avoid those conflicts, so they have like full motivation of working together?
Right. So yeah, that's a great question, because one of the things in the data room should show, how much equity each founder has, and also is their vesting. Is how does it vest? Does it vest quarterly, monthly? Is it 1 year clipped? Is it vested over 4 years? Now I'm seeing things like 5 years and even longer. And then some of the hirees, I've seen stuff where it vests over 10 years and all this crazy stuff. But so that really needs to be set up in the beginning, and not just be like, hey, I agree with you, 50-50, blah, 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 and, don't worry about it. It all has to be in writing and how it works out. And it's important, too, to make sure that everybody understands dilution, because I think a lot of early founders don't understand, just because they had 50% of the company in the beginning, when you get diluted, everybody gets diluted. And by the time you have an exit, your ownership could be 5%, it could be less, or it could still be 40%, depending on how much money you raised.
Yeah, thank you. Another question, Electitarian is asking, hi, my company Longevity in Time makes an AI health tracker which tracks on early stage CV disasters, calculates risks, and gives recommendations how to avoid them to live actively longer. We are pre-revenue, but we have apps in mobile stores with 500 non-paying users. For the past 9 months, I have hired more than 30 teammates, developers, managers, lawyers, etc., from 11 countries out of valuation of $34 million, giving away only 0.2% of equity. So we have a 0 burn rate and 12-month runway. What would you like? How would you what's your thoughts on that? I think there is no really question.
Right. So he's done a pretty good job, but he's only given away, when he says 0.2, less than 1%, or
he has an additional note. Question: what is the best strategy for raising funds, since we don't need cash for operations, but need a partner to bring our life-saving company to 100 billion or more valuation?
Got it. So in his case, he might even look for a corporate partner. In the old days, a lot of VCs in the Valley and stuff were against. If you had a corporate investor, they saw that as bad. But nowadays, a lot of corporations actually have a VC arm. Like even Koch Industries, if I'm announcing that correctly, has their own VC arm. It's separate from the main company. So in his field, if he can find someone that's a great strategic partner, and obviously you should bet the heck out of them too, the way they bet the heck out of you, taking money from someone like that propels your business and gives you mentorship and access to customers and basically propels you, is probably the right investor. So like an angel or even a VC firm that isn't really experienced, because it seems like what he's doing is very specific. And it's like, a moonshot technology that could change the world. So in his case, he really needs to find a partner that's on the same page with him that can propel him. Yeah, and it sounds like he's in a great position to choose.
I agree with you, and I think this is the thing about strategic partnerships is as much as important in both in sales and in fundraising. Especially if you're entering other markets, you probably would need a strategic partner with lots of connections and customer base, if you're talking about sales, or investment reputation, investors reputation in front of tons of investors, so they can trust and get meetings with you. So I completely support that. What's your thoughts actually? What would be your recommendations for international founders from different countries who are trying to become global companies, and they are trying to raise capital? Of course, they're looking at the United States as the fundamental start for them, because the United States has the most capital for fundraising and like high-paying customers, and it's just and the evaluation they get is higher usually than the other countries. So, but the challenge they face is that selling remotely, especially at COVID time, is really hard. How would you recommend doing that? And raising capital remotely is even harder. What would be your recommendations, if you have any? And doesn't mean, I mean, you have a golden solution for that. We just entered in this reality, right? But if you do, what would be like maybe practical advice for founders doing that?
Right, so I have a couple of thoughts on that. Depending on the stage, and it sounds like most of these are early, if you can get to an accelerator in the United States, like Y Combinator, 500 Startups, Alchemist, well-known top-tier accelerator tech stars, that you should apply for that. And even though now they're actually 100% virtual, which is, like you said, is a new stage, you still have the network. And just having that stamp of Y Combinator 500 Startups, I think gives you kind of an inroad in the United States. But if you're a little bit further along, or if you're lucky enough to have a relationship with some type of VC firm where you're at, some of the firms like Sequoia have VC firms that are just in India, just in China. And that's really important because here in the United States, we may not understand the culture or how to interact over there, just like you may have the same problem if you're from another country over here. So if you can get a relationship with a partner at one of those firms, even if they don't want to invest, just via your relationship, you trust each other, they may be able to make an introduction to someone in the United States, which may or may not be at their Sequoia firm, but someone that can help you with customers, help you even become a mentor and advisor if they really like you or like what you're trying to accomplish, and kind of help you build from there. But this stuff will take time and relationships, but I think it's all about relationships and getting in the right networks.
Yeah, it seems like it's all about strategic partnerships. Instead of going after 100 organizations, you can find one. It might be not easy, but then they have access to those 100 and they will give you access to customers and investors. I agree. I mean, it's a great advice. Thank you. I think we're done with questions. It was amazing presentation, and I really enjoyed, and everyone has enjoyed. If you have any final words, recommendations, or anything you would like to share or say to the community, please feel free to do that, and you'll be closing basically our great webinar with you. Thank you so much for being.
Okay, yeah, thanks for having me, and thanks to everybody for the great questions and for attendance. And I would say, just don't give up. That, if you really believe in something and it's your life's work, because that's another thing that I look for, is it truly someone's life's work? And, it's hard to judge that, how's their life's work. But, if it's your life's work, when you get knocked down, no matter who says no, you just keep on going, you find a way. And maybe your original vision of how you got there, because you don't know how you're going to get there, essentially, isn't that way. If you keep on going, eventually you're going to find a way. Like, even if that was your vision, let's just say it wasn't the right time, and this time the startup failed. Well, no big deal. As long as you handle everything correctly with the wrap down with investors, now the timing's right. You have the technology or adoption inflection. You try again, and you have your big Facebook.
And that was James Sowers, top 50 business angels in the United States. James, thank you so much. We will be happy to have you on our community. I think you're already there. And
yeah, I think I signed up. Yeah.
Please connect with James on his social media. He shared his contact. This video will be posted on YouTube channel. And if you would have any questions to James, you can reach him out directly or through Go Global World community, or you can write to me. We will be happy to answer it. And if you would like to pitch to James, it's maybe a great opportunity, because you already know what his expectations and the recommendations. And one other note that James participates in our live pitch to global investors. He's on the panel of investors, and you'll be having an opportunity in future to pitch James once we have more global pitches for founders from around the world. Thank you very much, James. Thank you, everyone. And we'll see you again, guys, soon. Have a great the rest of the day. Goodbye.